All right, welcome back. Well, earlier today, we got another pretty good read on the economy, but it's kind of another day where the bond market is not really moving. The 10-year yield is at 4.46%, and as we noted yesterday, that's the same price that bond yields were at back in November. So what's it going to take to get borrowing costs on the move again? Either way, Rick Santelli's in Chicago with the bond report. Rick.
Yeah, you nailed it. Not only was 445 an important area historically, that's where we were before PPI yesterday. Think about all the things that have occurred since before 8:30 Eastern yesterday. And here we are basically around the same place. But there is a lot going on. Let's start at the beginning. Retail sales, a healthy rebound. Initial jobless claims, 3-month low, mid-April at 221,000. All the data was pretty darn good. And if you look at Fed funds, what they're implying, a week ago they were saying a little over 2 quarter-point cuts. Now it's at 1.7. Now I understand 0.7 of a quarter-point cut doesn't make a lot of sense, but it gives you an idea the market's looking for less. So to that effect, let's look at the charts. 2s, 10s, 30s all on one chart. What's similar there? 8:30 Eastern, when all that decent data hit, that's when we made the high yield. To me, that makes perfect sense. Stocks like a strong economy, interest rates go up a bit during a strong economy. That's normal operating procedure. Then right after the data hit, yields moved a bit lower. There was another issue at play. It's called technicals. Whether it's a 2-year, 10-year, or 30-year, they're all flirting with very, very big psychological issues. Just under 2%, or under 4% in a 2-year, 4.5% in a 10-year, 5% in the 30-year. These are big. You see it on the July chart. That's July 1st of all maturities. You notice how similar they are? We're now wringing out a lot of the disparities between short and long maturities because the Fed isn't necessarily in play as aggressively on the easing side, and the market totally understands that. And something else happens when the economy is doing better, labor market is doing decent, and we see interest rates moving up. The dollar index. You know, it was only about a week ago many investors were writing off the dollar index. Look at it now. It's at a 1-month high close. Should it stay at this level? And once again, we're getting ever closer to 100. Huge psychological technical area.